first question to you is, Mr. Powell has stated that if inflation stays high, we won't cut rates. That's quoting him. And this is the 10th consecutive month of rate hikes since March 2022. And Mr. Powell didn't quite confirm if the rates have indeed peaked. How would you interpret this? And at this point, does the inflation outlook support rate cuts or perhaps a pause?
So inflation right now is at 5%, down from the highs that we've seen above 9%. So in terms of inflation going down, for sure we've seen an edge of inflation going down, definitely with the intensity or the aggressive cycle of increasing rate hikes. So now in June we anticipate a slower pace, or at least a pause. Markets are now pricing a pause for the month of June, as inflation is going down in line with the hike rates that they've been working on since 2022. So I think in line with these, with the numbers. However, though, on the economic indicators aspect, the more they hike rates, the more the economic indicators will show a slowdown in the economy, and this is what they're trying to avoid. That's why they're kind of tweaking their policy a little bit right now, just so we can at least have a soft landing instead of a hard recession so far in the economy.
A soft landing instead of a hard recession. In fact, Mr. Powell also hinted towards that. But do you agree with that given the inflationary pressures? And my second question to you really is that the Fed right now has a couple of challenges to deal with. You have inflation, there's an imminent recession, several bank collapses have also happened. Do you think the Fed is on a right track as far as the monetary policy stance is concerned? I mean, we've seen some very strong commentary coming in from investors and economists today, some of them stating that perhaps we are running out of time to fix this problem. Do you concur?
I mean, for sure, Powell did waste a lot of time when he said that inflation was transitionary, and he took his time while taking this aggressive policy stance. However, it is working with a lot of 0.75 basis point hike rates. We've seen inflation come down a lot from above 9% to now 5%. So I think a couple of more interest rate hikes would be at the 2% target. With that being said, we're still not in the recession, and we are looking towards going in it. And I think that our markets are pricing in the fact that this transitionary period from market slowdown to a recession, it will be much anticipated. And I think a lot of the government or the Fed could use some extra tools to monitor that. But we're definitely going to see a lot of unemployment. There's already a lot of big companies and small cap companies releasing a majority of their employees. So definitely this has a really negative effect on the economy, but this is the only tool that they have right now, including the other problems that they're facing. For instance, the debt ceiling crisis, that they're also reaching the debt ceiling limit, and as well as the banking crisis that we're seeing right now, as PacWest already announced that they're looking for options or exploring options for a sale. So we do have some imminent problems and situations that are going in the markets right now. But so far, the stock markets at least, are keeping intact with the dollar's downfall and other commodities and other assets driving up.